So the Chinese economy is apparently collapsing again, but no one seems to have told foreign investors. Despite the calls for decoupling and de-risking, global direct investment in China has kept growing, with figures from some European and Middle Eastern countries soaring to record highs. During the first half of this year, for example, German direct investment reached a new high of 7.3 billion euros, or over $8 billion. Meanwhile, data for the first 2 months of this year showed French direct investment in China surged almost six-fold year-on-year. And it's not just Europe. The Middle East is also hot on China. Middle East sovereign wealth funds alone invested $7 billion in China in the 12 months since June 2023, representing a 5-time increase year-on-year. However, you probably wouldn't have known this if you read and watch Western mainstream media alone. So why are investors betting so big on China? Why are European companies ignoring their politicians' call for de-risking? And what does the Middle East pivot to China say about the rapidly changing international landscape? Welcome to this special edition of The Point with me, Liu Xin, coming to you from Beijing. I'm pleased to be joined from Portland, the US, by Professor Liang Yan, Kremer Chair, Professor of Economics at Willamette University. From Suzhou, southern China, by Mohsen Solhdoost, Assistant Professor of the Department of International Studies at Xi'an Jiaotong-Liverpool University. From Nevada, the US, by William Li, Chief Economist and Executive Director of Milken Institute. And here in the studio by Professor John Gong, Vice President at the University of International Business and Economics, Israel. Welcome to all of you. So, how big are European and Middle Eastern investors betting on China? I want to go to Professor Liang for the first question. As I mentioned, German direct investment in China hit record levels during the first half of this year, reaching $8 billion. And that comes on the heel of already a record-setting year last year. So why are German companies apparently so bullish about the Chinese market?
Right. Good to talk to you, Liu Xin. So I think the most important reason is because, again, China still occupies a very important node in the global supply chain. And China also has a very large market. They're eager, the 400 million strong middle class are eager to purchase products that are of high quality. There are a lot of times, made by advanced economies like Germany or Japan or the United States. And so by investing in these countries, they're adopting the strategy, the so-called in China, for China. So I think both from the efficiency-seeking perspective, companies from Germany wanted to invest in China so that they're able to, better produce at a better cost for their products, not only for Chinese market, but for the global market. And then for market seeking, investments, they are also coming to China in order to really satisfy Chinese consumers' demand. So I think that's mostly the reason. And one last point that I want to make here is, as we know, not only China has a very solid and strong industrial manufacturing base, but China is also leaping frog in many of these new tech, high tech, and green tech products. And that's why we're seeing companies like Volkswagen and BMW, they're not only investing 2.5 billion euros this year, respectively, in China to just build, not just to build production sites, but they are also building, R&D, they're building research centers. So I think that is a new trend that companies are not coming to China, not just for production, but for research, for development, and for some kind of joint partners in that technological development.
Let's stay with the European companies a bit more. And I want to go to Mr. Li for this question. It seems that the Germans are not the only ones. For instance, if you look at the French number, as I mentioned, it's one of the fastest growing sources of direct investment in China. Last year, for instance, data for the first 2 months of this year, again, show that French direct investment surged nearly six-fold year-on-year. How big are French companies stepping up their investment in China?
Well, one of the reasons of these European countries are investing into China is because China is a huge manufacturing automobiles. And the French and the Germans have a vested interest in getting to the frontiers of automobile production, in particular, battery-powered electric vehicles. That's something the traditional manufacturers in Europe don't have a clear edge on, and China is where the newest technology is. So it makes sense that a lot of the investments are sectoral-based. And I certainly agree that the green industries that China has pioneered are also areas that a lot of other countries, including, as you will mention later, the Middle East, a lot of the solar production is also based on the technologies that are developed in China. But a lot of these are sectoral stories where China is at the leading edge. A lot of withdrawal of investment has come from companies that have really not been able to do the due diligence that's needed to assure themselves about the type of investments to make in China. And so we'll talk about that later, I'm sure. But to sort of put a slightly different blush on the numbers, this resurgence that we see from Europeans make a lot of sense because they want to take advantage of the automobile production. But for other industries, for them to do due diligence and find out what opportunities there are, that ability to do due diligence has been limited.
Let's maybe come back to that in just a moment, but let's look at the Middle East story. And as I said, we have seen widespread media reports about Middle Eastern investors showing more interest in China. For instance, the sovereign wealth funds alone invested $7 billion in China in the 12 months since June 2023. That's a 5-time increase year on year. We're also seeing reports about state-owned investors in Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the UAE investing more than $2.3 billion into Greater China in 2023. So, Mr. Solhdoost, are we seeing really a pivot in terms of investment from the Middle East to China?
Yes, and there are a number of issues that pretty much address this. And first of all, China is the world's largest importer of crude oil, and almost half of this oil is coming from countries in the Middle East, like Saudi Arabia, Iran, Iraq, UAE. And from the point of view of these countries, we can also see that there has been an increasing interest to diversify the sources of investment and also diversify their investments beyond oil and gas. If you look at the Saudi Vision 2030, Iran-China Strategic Partnership Agreement, along the Belt and Road Initiative, we can see that China has become a significant partner in the region. And of course, beyond all of this, there are some geopolitical factors that matter a lot. China has either maintained a neutral stance on regional conflicts between the states, or it has stepped in to mediate between conflicting parties. A very good example is the Saudi-Iranian rapprochement that was mediated by China. So in the whole, in terms of global politics, we can say that there has been a China-led bounded order emerging in the region, which has been very appealing to the countries because it's been characterized by some sort of policy of non-interference and economic interaction. So this is what has made China very attractive to these states in the region.
We will expand on that in just a moment. And yet for the people who rely mostly on international mainstream media or the legacy media for information, here are some of the headlines about China's economy over the past month. For instance, that China's economic crisis, why Beijing won't give up on a failing model. This is on Foreign Affairs. Then fresh data shows China's economy stuck in the doldrums. This is the Wall Street Journal. China's leaders sweat over difficult to heat economy. This is according to the Financial Times, and the Chinese hangover is here, according to the New York Times. John, are these reporters and editors living in a parallel world as we are seeing? Which is the fact about investment, about opportunities in China?
Well, I'm not surprised that these journalists are bad-mouthing China's economic performance, but I think when they make the kind of statements, you have to think about, what's the reference point they are comparing to. If they're comparing to, the past performance, yes, China's economy is definitely slowing down because, sky is the limit. You can't maintain the same speed of growth forever. But if you look at, the overall growth rate compared with the developed world, for example, it's much better actually. Even one of the leaders in the Western economy, the United States, for example, is achieving 3% growth is considered a very good growth, and at least here in China, we're achieving something around like 5%. So I think in that comparison, definitely it's much better. Having said that, and I do want to point out that these are two kind of things. I think on one side, economy is has its own share of difficulties, so there's no doubt about it. But on the other hand, I think foreign investors' enthusiasm for China's market is still not waning at all. I mean, you made numerous points about European investors, Middle East investors. This is absolutely true. I think the key question is, what is the rationale behind foreign investors' investment in China? Mostly coming from two things. One is that China is a very large market. It still is a very viable place to make investment, and these companies want to take advantage of the market opportunities. The second rationale historically has been that China is, due to its supply chain complexity, supply chain facilities, it remains to be a very, very good supply chain hub for the world market, right? I mean, the second rationale is a little bit mitigated because of the geopolitical situation, the policies coming from Washington. But overall, I think these two purposes still remain to be very much valid at this point. Even, for example, companies like Apple, after a round of trials in India, in other places, they're still coming back to China. I guess Apple's operation coming back to China, back to Zhengzhou City in Henan province, it is not counted as part of the foreign direct investment statistics. But I think it's a very, very significant event. It signifies that China's manufacturing powers as a supply base for the global market still remains very, very valid at this point.
Let's talk about the United States a little bit, because this is such an important player in terms of investment in China. And I want to hear the opinions from our guests in the United States. Professor Liang, for instance. Now, the United States has been warning against or even intimidating investors, both domestically and around the world, to stay away from China, right? But from the numbers that I've been able to see, U.S. investment in China at least remains stable, if not growing continuously. What's the view of U.S. investors about the opportunities in China?
Right. I think that's a great question. And I think numbers don't lie. When you really look at the FDI inflows from the United States, it is steadily increasing. For example, 2021, there was $116 billion of FDI inflow from the United States to China. And fast forward to 2023, the number has grown to $127 billion. So in fact, I think, if you also look at some of the Entran China survey, 90% of the U.S. foreign invested companies in China are profitable. So that really defined these, I think, smear campaign to say China is uninvestable. In fact, most of the U.S. companies in China are making profits. And also just look at the broader, FIE, the foreign invested enterprises, their profit have grew, by 11% this year, which is much higher than the 3.5% average growth for all companies in China. So I think China still remains a really bright spot. And I think these business investors understand that. But of course, the geopolitical, risks are some of the concerns. And that's why I think some of the investors are diversifying, but that doesn't mean that they're going to reduce the investment in China. It just means that they would have to, grow the pie a bit bigger, right? Not just invest in China, but also perhaps in India. Now, that also, I think, goes back to the point that, China in a lot of ways, it's not indispensable, right, in the global supply chain. But at what cost, if you really wanted to so-called de-risk or decouple from China? Look at Apple, right? They have been talking so much about, switching their production to India. But we just saw for iPhone 16, they're doubling down the manufacturing facilities by Foxconn and in Zhengzhou. And they also just invested $1 billion in Zhengzhou to expand production, but also build an R&D center. So I think, again, we see many of these numbers, both from individual companies, but also at the aggregate level. I think the whole de-risking campaign is an abject failure.
Let's take a look at some of the bigger picture and some of the potential discrepancies we're seeing in the numbers. Although we're seeing these obvious bright spots in China's overall attraction to foreign direct investment, we have been seeing also numbers from Chinese authorities about a drop in the actual use of foreign direct investment, sometimes to a rather considerable margin. Mr. Li, I wonder your understanding of the bigger picture and the longer term trends versus the bright spots. China performing better compared to other countries, and yet is it on an overall slowing trajectory of foreign direct investment because of the global sluggishness?
I'm glad you've reframed the question that way. When you have economists throw numbers around, you can really have a huge battle of the numbers that don't mean anything. For example, net foreign investment into China actually was about $33 billion in 2023, which is an 80% drop from its value in 22. So on a net basis, there's a huge decline in direct foreign investment into China. But I think the issue is the more important one is what you're talking about. What is the attitude of Western investors toward China? What is this attitude that they're getting about China not being investable? Why did this attitude come? After all, I used to work at Citibank, and Citibank has been in China for many decades, since the turn of the century, the 20th century. And when we were there, everyone had the attitude that the China market was a very important market because Citibank was able to provide a technology for banking and financial markets that helped China really develop and grow very rapidly. How did that attitude change? Right now, Citibank is still there, and they still value the Chinese market, but other investors who are not established in China are having a hard time finding their niche because the ability to do due diligence and find these good investment opportunities has been much more limited because of the new security laws and the way that they've shut down many Western companies that help companies in the West come to China and find out investment opportunities. So that really is the biggest change in attitude that's taken place in the last 2 years. And when I talk to investors, we at the Milken Institute talk to a lot of institutional investors, and the talk continues to be China is investable, but we need to find out where and how. And getting that information is really the vital part of the procedures that has become much more difficult.
Right. It's Professor Solhdoost, what is your take? I mean, China in this critical transition from quantity to higher quality, the new quality productive forces that China has been talking about. And in this process, competition is extremely keen. So does that impact the amount and the attitude of foreign investment or investors?
Well, in terms of attitudes, we can look at the Arab states in the Persian Gulf and can see how they have actually managed to balance their foreign relations by engaging with China. I'm not talking about in terms of numbers or the quantity, but in terms of quality, it's been very important for these countries. They have significantly reduced their reliance on their traditional Western allies, the oil revenues that used to come from these allies, and they have invested in sectors like technology, infrastructure, manufacturing, renewable sources of energy. And of course, on the other hand, for China, the Middle East has been a very important, it has represented a crucial market for its services, for the investment, and it also provides an opportunity to China to replace that the dominant force that used to be in the Middle East through the economic interaction, which is the principle of the Chinese-led bounded order that I talked about. So speaking about the attitudes, we see how China has been pursuing those Belt and Road Initiative policies, trying to secure the trade routes, infrastructures in the Middle East, in a lot of these countries in the Persian Gulf, and it has been very appealing to these countries as well.
These investors have definitely, especially the ones from European countries, have definitely defied calls by European and, for instance, national leaders about de-risking from China. We understand, for instance, EU Commission President Ursula von der Leyen and German Chancellor Olaf Scholz have been calling for companies to de-risk. The latest news is also about their latest decision on imposing tariffs on Chinese-made clean energy cars. John, why are investors seeing things differently? Who are in the right?
Well, I think companies, executives know best about their risk when it comes to de-risking. What does de-risking really mean? I think that the idea of de-risking means that the idea, the concept or notion of over-reliance upon China. In other words, it's a diversity argument. But when it comes to diversity in its company's supply chain, executives don't need preaching from politicians. They have not. I mean, Wang Yi know nothing about industry, nothing about a particular company's business. For example, let's say BMW or Mercedes-Benz. How does she know anything about these two companies' risks associated with so-called over-reliance on China? So I think this is something that is preaching to the choir. I mean, companies know much better than the politicians, and they put their money on the line, and they will take actions by themselves. I mean, they don't need education from these politicians. So I think the fact that these executives make decisions to continue to invest in China, manifestly illustrates that they think the risk of the diversity risk is not that big, actually. So I think it's something that has to be left to the investors, to the company executives. I think this is something that politicians shouldn't be meddling with.
Mr. Li, you were smiling a little bit just now. What is your take on what do you think politicians are trying to do? The United States also talk about, or potentially there could be hard decoupling with China. What are these politicians trying to interfere with business? Isn't capitalism about letting business, do their business in a free market economy?
Ideally, we would say exactly that government should just get out of the hair of most business people. But unfortunately, every politician wants to bring jobs back to their location. And what the United States is trying to do is to say, well, we can really compete with China if you only give us a chance. And there's a lot of subsidies now being thrown at companies to try to invest more of those resources at home or in friendshoring into countries that are more allied to the foreign policy objectives of the United States. So I think the key here is are you talking about old investment that's already in China? Well, those companies are readily easy to find more opportunities in China because they know the Chinese market, they know the regulations, they know how to do business in China. The key for China now is to attract new money, new investors to come into China to take advantage of the incentives that are being given for the new technologies that are available in China. And that is what the politicians are trying to compete against. The United States is trying to say, well, we're also wanting to develop these new technologies, and we're trying to incentivize companies to stay here. And now the key is there's a fight between what kind of subsidies we can get to bribe people to stay in the United States versus the other investment opportunities for the actual developers of the new technology that are located in China. After all, China is the place where, if you're going to make electric vehicles, that's the place to make it because you guys have the best manufacturing technology for that. Going further into other fields, the quantum computing, artificial intelligence, those are areas that China is now neck and neck with the United States and Europe and every other part of the world. Yeah. But how does a new investor find out where these opportunities are in China and how to take advantage of them? That information is not readily available.
It seems that there is this perception that investing in China means a loss for other countries, or investing in another place means it means a lost opportunity here in China. And yet, if you look at the latest IMF analysis, 1 percentage point increase in China's GDP growth would result in an average of 0.3 percentage point increase in growth for other economies. Professor Yan, shouldn't we be approaching this notion of investment from a more win-win, all-win perspective? Investment in China doesn't mean less jobs or losses for Germany, for France, for the United States. Maybe that is the way to go?
Right. I think from an economic rationale point of view, yes, we're looking for, mutual cooperations. We're looking at division of labor. We're looking at, economies of scale where countries can work together and, together bring down that, production cost and advance technological improvements. But I think, I hear what William was saying. But I think, in terms of the U.S.'s strategy, I think they err at least on two different aspects. one is really elevate the security concern to a really unreasonable level, right? Whenever China makes advancement in certain technologies, then the concern is, will they use this in military? Would this become a weapon against us? And I think that's a very lose-lose mentality. And second, I think importantly is, I'm not against of industrial policies that try to promote, especially green technologies and green transitions. We all need this in this overheated planet. But the problem, I think, for the United States is that on the one hand, they're bribing their companies, giving them so many carrots, but there's no stakes to hold them accountable. At the same time, bar China away from the market to reduce the competition, to protect the domestic companies. And so they're able to, spend $1 trillion last year, 2 years ago, to buy back their stocks, not much less last year, as a matter of fact. So I think that is really not helping U.S.'s situation. And of course, trying to create this kinds of, geopolitical so-called risks for their companies. And I also want to just add one quick point about the data. I think William cited the number from the State Administration of Foreign Exchanges, and a lot of these calculations are not just strictly by the utilization of FDI, because the whole point is to monitor foreign exchanges transactions across the border. So I think the MOFCON, the Ministry of Commerce's number, is really a more reflection of the really on-the-ground business operation and investment in China. Mm-hmm. And even though that does show some decline so far this year, I think, again, like William is saying, is that some of the companies have to exit the market. They have to rethink, recalibrate their market strategies in China. Think about, Apple has been really fierce competition in China, has fallen out of the top 5 in China. So I think, for many companies, they do need to seek opportunities and come to China, invest in areas where they have competitive advantage, but also have the potential, and exit the sectors where, their advantages is eroding.
Okay,
I think, yes, China's changing.
Let's focus a little bit on the future. John, you wanted to say something? Jump in here, but make it short, please.
Okay, I want to address William's point about, the optimized resources across geographic regions. I think ideally, it should be market-driven. I give you an example. BYD is very good making electric cars. Tesla is very good at making the autonomous driving capability. It's a very nice allocation. It's a very nice arrangement in a global market. But the problem is that when a country is constantly thinking about national security aspect of this, when a country is thinking about the entire defense industry is built on so-called manufacturing, then there's a problem here. United States economy is like 18% service, right? But I think okay. They want to bring manufacturing back to the United States. I mean, look at the unemployment figure in the United States. It's only 3%, 4%. It doesn't need this kind of jobs. But the problem is the national security angle. That is actually making the free market allocation of resources across the globe, making a big problem.
Right. Let's just go very quickly about the future, talk about the future. Solhdoost, 1 minute, please. Where are Middle Eastern investors looking at over the next 10 years? I know there are some huge plans about investing in China, but make it really short. 1 minute. Keep it within 1 minute.
Sure. Well, speaking about the future, it's worth noting that the Middle East undergoes rapid urbanization and infrastructure development, and there is a high demand for construction materials. That's pretty much where Chinese companies cover the market in the Middle East. And of course, oil and gas are obviously still the most important area, but there has been an increasing focus on infrastructure development. Technology and telecommunication has been also very important for these Middle Eastern countries.
All right. And in one word, yes or no, John, are we going to see more European businesses investing in China, defying politicians' calls?
Absolutely. Absolutely.
Well, we'll keep a close watch on the situation. Many thanks to my guest, Professor Liang Yan, Mohsen Solhdoost, William Li, and John Gong. With that, we come to the end of this special edition of The Point with me, Liu Xin. As usual, you can follow me on Facebook and X using the handle Liu Xin in Beijing. Thanks for watching. You've got The Point.